Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. I'm Patrick Smelly, the editor at BusinessDesk, and today on Shared Lunch we're joined by Ross Taylor, the CEO of Fletcher Building. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Ross.
Oh, thank you, Patrick. Good to see you.
Last time we spoke to you, things look a little rosier for Fletcher Building than they perhaps do at the moment. Tell us, where is the company at right now?
Yeah, firstly, let me just context, because I think there's two parts to the story of where we're at right now. If I look at the results, underlying earnings, profitability, and a lot of our non-financial metrics also very strong. The disappointment in our earnings was really the provisions we had to make on the convention centre, which is just where insurance proceeds aren't covering the costs to get it finished. So that was a disappointment. But then if you step back and look at what's going on in the underlying business, I think it was a very strong result for the business.
Well, let's just unpick that. Yeah. Let's get the bad news out of the way first.
I would lead with the convention centre, wouldn't I?
Well, thank you for doing that. Well, the convention centre does seem to have been a bit of a black hole in some ways. You obviously the fire made it that much worse. But I think one of the things which, reading through the Analysts' notes, is that there's now this kind of sense that they want to believe the story that Fletcher's cleaned the books and now this is the fresh start moment. But there's always that wary feeling that maybe there's something more. How do you deal with that? I mean, it's an inevitable reality, isn't it? Yeah,
and at the end of the day, you've got to try and describe the position we're in. And what we did in our latest results is, look, firstly, the convention centre is tracking well, but it's not finished till it's finished. So where we are with the convention centre is that we're about to hand over the second lot of car parks. So all the car parks are finished and handed over in the next week or so. The hotel will be finished pre-Christmas, and then the whole shooting match by the late next calendar year. The thing with saying that is that therefore the production's good, and therefore when it's finished, you stop spending. So that's when you're at the end. So as we get close to the end, the risks get lower. So what we've tried to do in our guidance on our projects is just really try and say, look, here's the risks. So this is where we are, and we've sort of talked about what the revenue risks might be on some of the projects we finished, the big road up north, Pilwell to Warkworth and that, and just explained, okay, they're the risks and that's what we have to finish over the next year or so.
So can you just lay out for us what is the extent of the most significant risks that you face at the moment?
Yeah, there's three what I call legacy construction risks to go. On Pilwell to Warkworth, the road's opened, as everyone would have hopefully enjoyed driving down it.
Yep.
What really we've got to now wash up with is finish some last bits of work that we couldn't finish till the road actually opened. So we're doing that, which is a small amount of work. But what we've got to do is close out what I call our COVID delay claim. And we've flagged that there's a claim with Wakatari of over $200 million to work through on that. And that's more of an income risk than a cost risk, because it's how much of that do we get? So the cash is out. So how much revenue do we get in FY25 or whenever we work through that? On the convention centre, as I said, we've come a long way on it now, but we've got a bit of cost risk because we've got a bit to go yet, but not a lot. And then what we've got is insurance money is the predominant risk, and we've got there's two parts to insurance, and what I call the normal contract works, but there's another bit of insurance called third-party liability. And I won't get into that, but the contract works, they've agreed they've got to pay it. On the third-party liability, we're going to have to prosecute that probably through a dispute process.
Right.
And so again, it's more of a revenue risk.
How long is a piece of string as to how long that takes?
Oh, look, it won't. I think it'll be a while. I mean, I don't think the insurers will lean into that. And then the other major discussion we've got is down on Wellington Airport, where there's some work that needs to be finished, and they've put a claim on us for $40 million, and we obviously don't agree with that and disputing it. But that's the other big number out there. So we've talked about that as a risk profile, and predominantly a bit of cost risk in there, but mostly how much money do we get in from here.
What about the Western Australia and I think ILEX? Is that the
the leaking pipes?
Yes.
Yeah. So where we are with that is that, to give you a sense of, so people understand it, we made a pipe product and it's gone, and we don't make it anymore because when we were cleaning up the Australian profitability, we got rid of all the products that weren't making money, and that was one of them.
Right.
But in the period of discussion, which is about 5 years from 2017 to 2001, when we were selling the pipe, it went into 30,000 houses, 15 on the East Coast, 15,000 over in Perth. What we're seeing only in Perth is abnormal leak levels. So we're not seeing it anywhere else in the country. And to put that in context, around 1,500 houses have developed leaks that product's gone into. So we've been doing three things. We've basically been trying to work out, well, what's causing it? Is it our product or is it something else? What's the best way to fix it? And then what's a sensible industry solution? And we put a provision in for $15 million to enable us to get into houses, because what we said to builders, they wouldn't let us in.
Right.
So the only way we could get into the house to work out what was going on is say, look, we'll pay for the fixes.
Right.
While we're doing it. So what we did is we've basically sized that around a year of fixes. And the reason we wanted to do that is, as we've been doing all our testing of the pipe, we're actually finding the pipe is okay. And when you look at what the fact it's not leaking on the East Coast, you got to say, well, it doesn't look like pipe, but we've got a few tests to finish yet. Yeah. So as we've got in and started looking at, we've been in about 250 houses, we're seeing a really high correlation to installation and the leak. So installation not compliant. Now we've still got to work through all that. So and as we do that, that'll get defined a lot more crisply. We've got to work with the regulator in WA in Western Australia and bring all that together. And so we aren't going to shirk from helping the industry. What is the technical fix and what is the ultimate way the industry can work together to solve it?
And obviously nobody ever wants to have any impairments of that 50 million or so that you've had to set aside is not a sum you'd want to see grow. Presumably, if you're seeing installation as the issue rather than the product, then you'd be reasonably confident, I guess, that the ACCC won't take a wider view about the product itself.
I haven't said that in the market because we've got to get through this first. I mean, we've got our emerging view. We haven't finished our tests, and that's the next 6 to 8 weeks. We should be through that. Then we've got to get the regulator to agree with us. And then we've got to actually work through with the industry. So I can't categorically sit here today and take that off the table as not a bigger issue. I can only talk about where we are now and where the direction of travel is.
No, I get you. So let's talk then in broad terms, your most recent result, the immediate outlook, and then perhaps we might go into a bit of depth on each of the major segments. Talk me through the most recent result.
So it goes back to what I said at my intro, is that our profitability, and I talked underlying, and I wish I wasn't, because what hit the result was the provisions predominantly on the convention centre to get it finished. But the underlying result, we were just under 800 million of EBIT, 9.4% margins, so and good underlying cash flows supporting that. And as I mentioned, our non-financial metrics were good too. Our safety improved again, so our injury rates were down another 12% to 3.1, which is a good industry level, heading towards top quartile of global companies. Our employee engagement went up. Our customer engagement went up to a promoter score of 40 now. Best practice is above 50, so we're getting close to that. And our road to sustainability, decarbonisation, we're now 18% below our 2018 levels. So a lot to like in that. And then the other thing we've been pointing to is the business underlying is in pretty good shape, or good shape. I won't diminish it. And then we've also pointed to the fact that we've invested 800 million into growth opportunities above and beyond our normal activities, and these are in adjacencies, and they've all been done at 15% returns is what we're looking for. So there's 100 million plus of profit we'd expect to see in the business when we finish those investments in probably FY 26, 27.
A couple of examples of where that incremental growth comes from?
It's been going into a couple of acquisitions, but that's not the main thing. So we Waipapa Timber, so a structural timber mill up in the north. It's gone into growing our network in placemakers in the Hawke's Bay area. It's gone into then what I call organic projects where we're investing. So we're putting 270 million into a facility or a factory down at Taupo, which is what I call a value-added facility to timber products. So think flooring, think board products.
Yep.
And what we've done in terms of that one is it's a great example where we're looking around the world at products that are established internationally but might not be here.
Right.
So where can we bring world's best practice for cheaper, better products into the New Zealand market? And it's good for the country, but also good for our business. So we're very thoughtfully not just building capacity at the top of the cycle, or it's not no longer the top, it's come off since then, but actually looking for those adjacencies.
Yeah. Where do you think we are in the cycle at the moment?
It's a good question. I mean, I'll give my best go at answering, but I got a health warning. I usually get this wrong. Yeah,
that's okay. Me too.
We're in good company then. So if I look at the year just been through FY23, which finished the year finishing end of June for us, it was interesting. The volumes across all our sectors held up pretty well to the last quarter. So from about April or May, what we then saw is all the sort of backlog of residential that was working through the system. So we really saw, I think, the volume part of our products going into the residential market find their true level. So it came off quite a bit, and I'll context that in a second. So what we sort of saw that last quarter was really a real step down, and our revenues or our volumes through FY23 as a result were probably about 7 or 8% down on the previous year. But it all happened in the last quarter.
Right.
And then what we've seen since then is the market sort of bubbled on about that level as we've gone through this year so far. So that means it's sort of, therefore, residential came off about 15-20% in volume terms. And that's where we're selling plasterboard, selling products, timber and stuff, placemakers into the market. We'd already seen that occur, though, in our residential housing business. So because that's sort of like it's a lead indicator, because we'd already seen house volumes drop, prices drop. So it finally is flowing through to the market. So as we sit here today, infrastructure, non-res feel there or thereabouts. They feel pretty solid still. Maybe a bit infrastructure a bit up, non-res a bit down. Residential, as I said, is down that drop we saw in that last quarter, and feels like it's going to bubble along there just based on what we're seeing across our business. So it's just hard to tell where it's going.
If things come off a bit, though, presumably some of the inflationary pressure has come out of the market as well. I mean, how have you gone in terms of managing margin? And just because you've had 7 or 8% reduction in turnover doesn't necessarily mean that that's been the impact on the profitability of the sector.
Our profitability year on year went up to 9.4%, as I mentioned, across all our businesses. We probably did a little bit better than inflation, but we've been quite thoughtful about that. A lot of our increase in profitability has come from what I call the structural changes we've been making in the business. And Australia is a classic example where its margins were at 6%. So the year before they were at just 4.5%. And that's on 3 billion of revenue. So that has a big impact on our overall group margin. So it was less about us taking, we basically held our own on price, but we didn't sort of get much more than that. And the big improvements were more around the things we've been doing to drive the performance of the business in an underlying sense. And if I look,
so there's some secret sauce in there, which
no, I actually call it housekeeping. If I look at the journey of the last 3 or 4 years with Fletcher Building, it's I'd love to say it was secret sauce, but it was really getting the basics done well. We had a lot of things we needed to do around, well, which products were making money, we'll sell those. Turn the ones off that weren't. Were all your factories running at what I call where they needed to be in terms of what importers could do? Or was the cost point right? And where it wasn't, shut it. Where it was, how can you improve it? And we did a lot of consolidation of our manufacturing footprint. What was our distribution? So all the things you can do to get your business running efficiently. Did we have too much overhead? So we put a lot of that work through the business in the last 3 or 4 years. And we're really now running quite well in that context, so operationally quite fit for purpose, and that's what's been progressively dropping through to the bottom line over the last 4 years.
So in a perfect world, if you assume that we're either bouncing along the bottom of if you can bounce along the bottom of a cycle, I'll eat my hat. But if we're going through a flat patch, every economic forecast I see says we've got 24 is going to be pretty boring. But if you're running the business reasonably efficiently at a low point, presumably you would hope to be well placed in the event of the upturn.
Yeah, so that's a good, because none of us really know when the market. I mean, what I don't know is I look to calendar 24. Is it more of the same, or do you start to see an improvement? It's really hard to tell. Or is there a little bit? I don't think there's a calamity waiting. And as sure as I say that, I'm probably going to cause one. But it might ease off a bit. It might be more of the same, or maybe you start to see improvement. It's very murky what's going to happen.
So you're not taking any heart from the extent to which it looks as if the New Zealand housing market anyway has bottomed out.
Yeah, I do think that's why I'm probably not weighted to too much downside as I look forward from where we are now.
Yep.
What I can't see is what's the trigger for a whole lot of momentum up.
Right.
But if I look at our residential business, which is sort of a good indicator for us, it's sort of once we got to about May, the sales sort of stabilised, prices stopped going down,
Yep.
and we've seen good volumes in that business now right through and continuing.
I think you're looking at an increase again in total units sold next year.
Yeah, we end up only selling about 617, or 617 precisely.
Exactly that many.
Exactly that many last year. We're sort of saying 700 or 800 as we sit here, but it'll be interesting to see if we're probably doing a bit better than that. But it's a long year to go, and we've got an election in the middle of it, so it's a bit hard to call yet.
Do you think the election? And I know I'm not asking you to make a political comment, but do you think the election is having
well, you
an
can
effect?
try.
Is the election having an effect on business conditions here that you can discern, and do you have expectations about what might happen after the election?
What we're expecting, it's sort of as we get closer to it, a little bit of uncertainty comes in, and decisions of either whether it's householders, do they buy or don't they buy, and some investment in business sometimes can get held off till people just see where things are going. So yes, we're sort of seeing a few of those things slip out, and even some government expenditure that wasn't already committed, from some of the various. Sometimes that gets on hold as well. So what you inevitably see around into and then after is it always has a bit of a dampening effect for 2 to 3 months around it. Yeah.
We do know though that New Zealand still has a shortage of housing, particularly if migration continues to boom as it is at the moment. We know that public infrastructure is a deficit there of substantial proportions. So I presume that in terms of a sort of forward workflow, it's a reasonable outlook. Yeah, look,
I and we are very bullish about the long-term, medium-term opportunity here, and that's why if I look at us in residential, we'll say we do about 700 or 800 this year. We can easily move that up to 1,300, 1,400. In fact, we only pulled back on those levels because of where the economy went. So what I'm just waiting for is when do I move? Because right now we have about 800 million, 850 million of capital in our residential development business. To take it up to 1,400 units here, it probably needs another 300 million.
Yep.
And I just don't want to do that until I get a lot of confidence in the cycle. So we're watching, and as soon as we get confident in that, we will do that because we've got the sites and the consents to do that.
To be able to do that. These are obviously analysts' forecasts rather than your forecasts, but looking at the forecasts for Fletcher Building over the next sort of 3 or 4 years, a couple of brokers' notes that I've been through, it's a pretty flat outlook, even revenue-wise. So it's not quite consistent with the idea that at some point you go on a tear.
Yeah, look,
what's that about, do you think?
Look, so a couple of things. Firstly, what I've been saying and what we're doing is that, if I look at it, you've got to decide where do you think the market is in the next year. So is it there or thereabouts, or has it got more downside, and that then dictates what you think revenue will be. But let's assume it's there or thereabouts. So I think we're well positioned to manage ourselves well through the sort of present cycle. Then you're in a debate as to when does it start growing again, and once it grows, then we are leveraged to that growth because our businesses naturally will grow with volumes. The other thing, as I mentioned, is we're making 800 million of investments, which we think will generate over 100 million of profit.
Yep.
And if you sort of say that's at 15% margins, it gives you a sense of the volume we'll add from that. And we're making those investments, and we're making them on the basis of what I call the present cycle levels, not on some sort of hope and dream that the cycle does change. So I'm very bullish on the outlook for Fletcher Building. And why the analysts won't believe it, I guess they want to see it first. That's all I can say. We've been very transparent with that story.
Interesting. To help viewers and to help me, what's the relative proportion, New Zealand versus Australia, and of those two markets, where are the biggest opportunities?
Yeah, so if you look at our roughly 8.5, so call it 9 billion, it's easier, the maths gets easier for me. So roughly about 3 billion of our revenues in Australia and 6 in New Zealand. So it's about one third, 2/3. If I then look at the immediate opportunities for me, they're more New Zealand centric, and when I look around our businesses, and most of that 800 million is going into New Zealand,
right?
Because we see a lot of opportunities, in the timber area. We see it around insulation business because the codes change. So you've got to get houses more thermally efficient. So there's investment going there. It's in what I call the modernisation of our factories and getting our costing down. So frame and truss automation, those sorts of things as we make frames for houses. And it's going into, we see a big opportunity in circular. And what I mean by that is, if I look at our concrete business, cement business, firstly decarbonise it, but then more and more often what you're then doing is you're going out and bringing old concrete in, crushing it and putting it in. So
really?
Instead of it going to landfill, you're reusing it.
Reuse it.
We're up in Golden Bay where we make cement, where half of our coal's displaced with old tyres now.
Right.
We're actually, and then we can use waste treated timber that would normally go to landfill. We can use that. We can use plastics in there. So what we're really focused on there is a huge, what I call circular opportunity, which is not just a cost, it's actually a profit opportunity as well. And it's good for the environment. So New Zealand by far has got where the lion's share of our media investment's going. In Australia, we're a much smaller fish over there in a bigger pond.
For sure, yeah.
So, but firstly, what we had to do in Australia is it wasn't making a lot of money. So that 3 billion of revenue was only making 1 or 2% margins when we started.
Yep.
And so the first thing we want to do is get our house in order. And this year we're up to 6% margins. So we've come a long way, and now we've got the business in a more sustainable, more fit for purpose place. And now I'm much more interested in what I can invest in and around it. And again, it'll be more like what we're doing in New Zealand. It won't be big acquisitions. It'll be what are the adjacencies. There might be a few bolt-ons, but fundamentally, what's the organic investment? I much prefer it's safer, if you're doing that, because it's more controlled and you're more controlling your own destiny as well.
So when you've got home ground advantage in the New Zealand market, but it's a much smaller market and a much less, I dare to say, dynamic economy than Australia's. If you look at the opportunity in both economies at a high level, what would you expect that sort of 2/3, 1/3, sort of 3 billion, 6 billion mix to look like in, say, another 5-10 years?
Well, I think in 5 years it'll probably stay pretty similar. But if you go out in the long term, inevitably the Australian business has more opportunity to grow bigger. So that might start to change, which is it's important we're over there, we run that business well and we run it effectively, because ultimately it's a bigger economy and you get more opportunity.
Yeah.
But what I would say is that everyone keeps saying New Zealand's not that competitive. Boy, oh boy, it feels it at times. And if you're not competing locally, you are competing against internationals, and you can't underestimate that, because what you're always you're betwixt by is that you can go and put big plants in Asia, and you get the economies of scale. And sure, they've got to ship it in here, but they get a lot of it. So you've actually got to better get enough scale in New Zealand to actually manufacture here.
Yes.
And if you don't, you can't get your price point down enough to survive. So I find the market very competitive in its own way.
A little bit off-piste, but there is a lot of discussion of, and I presume that even with a change of government, it would probably continue, of attempting to make the building code less prescriptive and more capable of bringing alternative building forms and so forth into the New Zealand market. And I hope, I guess, that it makes it a bit more competitive. Do you regard that as being a significant source of either threat or opportunity?
No, I actually agree with it. I mean, for all the Commerce Commission stuff, I mean, that's probably one of the main recommendations that came out of it.
Yes.
And so I'm actually a supporter of that, because some of those complexities betwixt us as well, in our businesses, and you've got to get all these approvals, and it's very slow to get stuff done. And the way I look at it is that when we look at our businesses that we invest in, they have to have a manufacturing cost point that is competitive locally and internationally. And if they don't, we don't invest, because you end up you can't win in that equation. So it's not about the regulatory environment at all. It's actually about how effective and how well are we performing, and we benchmark every business internationally.
What future or possibility do you think there is for New Zealand, which has a tendency to go for bespoke homes?
Yep.
Even kid-set homes have a lot of bespoke elements to them. Yep. To moving much more to a modular type of approach. Why haven't we seen more of that in this market? Isn't that something that you guys could be? Well, you must have looked at and are in.
We're actually really trying to push it because we. As we mentioned, I do about 800 houses a year ourselves, and we've invested in a offsite house manufacturing facility we call Clevercore. And as we've been doing that, you've got to get standardisation. So about 1/3 of our own product we build that way, and it's higher quality and blah blah. But getting that going through and getting that right has just been a long journey, because you hit all the bespoke nature of things. You hit all the way the codes work, the way the building approvals work. So we're actually, 3.5 years on, we're actually pretty close to cracking it, and we've done a lot of standardisation in there to do it. And you have to do it in a way though that doesn't devalue the house, because people don't want to go into a standard house. They want to go into their house. So you've got to actually do the standardisation in a way that still allows you to express some individuality in the housing solution. And we think we've cracked that. But I think it's a real opportunity for New Zealand. I think it will inevitably go that way as more automation comes into the industry.
Yeah. At your Investor Day in June, you flagged potential uplift in construction costs of as much as 50 million. What's driving that?
Oh, that was when we were talking about the convention centre.
Oh, okay.
So what we were saying is, as we were talking about how do you think about what the risks are to finish it, we were saying that was what we were talking about.
I see. Yeah. I'm with you. Yeah. Other parts of the market, commercial property, you sort of were a bit.
Well, look, the way we talk about the market, and just to, when you look at the total building market, about 25% of it is infrastructure, roads, blah blah blah.
Yep.
50% is housing, which would all be, and the other 25% is loosely called non-res.
Non-res, right, okay.
and it's really non-res and non-infrastructure, so it's everything else.
Sheds through to offices.
Yeah, but it's offices, hotels, warehouses, factories, it's hospitals, it's it's even the airport. I think the airport infrastructure gets thrown in there.
Yeah.
And so when you look at that, I think clearly offices and hotels are going to be a bit softer through this period, but there's still a fair bit of money going and investment going into warehousing, factories, other things like the airport's investing right now, and then you and into hospitals. There's a bit of an education. So what you look there is we think that'll come off a bit, but not a lot. And on the other side with infrastructure, it was already a very robust pipeline, and unfortunately the events for all the flooding and the cyclone really have put an overlay into that, so that will probably grow from here in the medium term.
How do you think about climate change in a strategic sense for a company like Fletcher, where it's obviously upside and potential because we're going to need more resilient infrastructure, but also can knock you off course?
Yeah, so there's a couple of different levels in it. So firstly, if you just look at the impacts of climate change, like a lot of companies, we have to report against that. So when we look at all of our facilities, where we've got we're in very good place. So we have very little risk around that, and where it is, it's quite at the fringes and small investments. So, and we've got to look forward 70 years. So we have to do reports on that. So I'm very comfortable that our asset base is well located.
You haven't got any cement plants sitting on a tidal zone or whatever?
No, we're good. Yeah. So that's one of the first places you go to, because it's up high, but it's right near the beach or the ocean, obviously. Then you look at it in terms of, well, what is climate change going to drive in the industry? And you're seeing that in decarbonisation, but it's also not just that, it's the ongoing energy performance of houses, it's the environmental impact of products, it's biodiversity, and that is, you can take two views. And that train's left the station. I see it as a huge opportunity. So we have invested in opportunity funds that look into this in the world outside the world. We have our teams go out and we look for what the trends are, and what our whole aim is to see what the right trends that we can apply here are and bring them into the market first and stay ahead of that curve. So we're really doubling down on leading in that space, but leading with what we find are proven technologies that you can sort of see are working elsewhere.
Any good examples? What sorts of things are we going to see coming down the track?
Let's start in cement. I mean, the funny thing about cement, which is roughly contributing 8% of carbon to the world.
Yes, yeah.
Carbon debt. I actually think firstly, what's happening and what we're already well progressed on is getting all the fossil fuels out of our fuel, which is about 30% of the carbon in cement, and we're almost there on that. We'll have that done by 2030. Then what you've got to solve is the chemical reaction of cement and the sequestration and how you use that carbon. There's quite advanced technologies. I actually am very bullish in the 2030s that'll get cracked. They're there already, but they're not commercially scalable yet.
Right.
And they will be then. And then I think cement and concrete will become a carbon sink. So I think it'll go from a bit of a nemesis to a real virtue. So I'm very bullish on the outlook for that. If I look at timber products, there's so much innovation going on. Timber's not going to be the answer because the more timber you use, the more you're hurt biodiversity. But there are actually supplements going on in timber and some real interesting technologies of polymers and stuff they're using which will drive that. Then you jump over into things that are driving thermal performance of houses and insulation and different wall systems. And again, there's so much innovation going in there, and we're doing it at the product level, but we're just doing what we call our low-co house. So it's a low-carbon house where we're trying to combine all of those, and we're building our first couple of those now.
Yeah,
and basically they're really performing at an amazingly high level. They're not quite affordable yet. They're probably costing double what a house costs, but we've got to start that.
Then we understand it.
Then we can innovate it. You know? So we are doing it right across our business, and it's quite exciting because it's driving innovation in our business. It's actually allowing us to get ahead of the curve on things, but it's also our staff and people love it because we really are genuinely leaning into it and trying to improve things. So yeah.
Are there segments where you aren't at present but could go, like for example rooftop solar or other energy production?
Yeah, as big as people think Fletcher Building is, we're
not that big.
We're not that big, you know. So there are plenty of places we don't play and places we can, are playing. So the way we look at it is we sort of look for opportunities in segments of that broader building value chain where we think we can compete effectively and there's a reason to go there. And there's a lot of places where you think, it's just not, the structure doesn't work for us. We really aren't going to be able to make money there, and why would you? And there's other places where we think we can disrupt or bring an innovation in, or when we can go in there and not only provide something for the customers they'll love, but also make money doing it. And you've got to get that to line up. Otherwise, you just make fanciful investments that no one's going to thank you for in the long run.
So the discipline is on. Just do the.
Oh, look at the beauty. What's
not quite stick to knitting, but
really
close.
The 800 million we invested in, we've probably, as we've been pushing the teams to look at these innovations, there's a lot more we could go after, but we've just cherry-picked what I call the best ones, and we've paused for the moment because I think we've got enough growth into the business, but we just want to wait for the economy to sort itself out. So I don't want to, overstretch balance sheet and stuff. I want to keep that at sensible levels and so we don't overstretch ourselves until we know exactly where the
market's going. You do get to a point where you're not overstretched against your own metrics, but I'm trying to remember the metrics is net debt to EBITDA.
Yeah, we
around 1.8 towards the end of next year.
Yeah, that's about where we peak. I mean, and we always say we want to run the business between 1 and 2. And we always you don't want to be too under leveraged either, because that's not the optimum thing. But you want to be sensibly leveraged, is my sense. So we're
what's driving it, because it's going from a reasonably low level up to.
It was our growth investment. So what we said is, we did a few share buybacks on the way through just to distribute capital back to shareholders, but we didn't want to go too far because we wanted to keep enough in our tank to go after what we could see an emerging set of really good growth opportunities for the business.
And dividend-wise, perhaps a little bit disappointing this time, but kind of not out of court given the circumstances of the result. What should shareholders expect, both on the distribution policy and meeting the higher end of that, what also imputation?
Yeah, so a few questions in that. So let me unbundle them. So firstly, we've got a policy to distribute 50 to 70% of 75% of profit after tax.
Yep.
And this last year we distributed just under 60%.
Yeah.
So it was sort of
59-ish, wasn't it?
59 point something. Yeah. You're obviously well researched, so you didn't allow me to round up. So good try. I tried. Yeah, I got to try. Yeah, fact meets marketing. Sorry, and I think the important thing, it was a bit lower than people may have hoped or expected, but I'm a big fan of dividend following business performance. Yeah, and there was a bit of a headwind with the extra provisions we had to make. So we look at the range and we look at the cash, and we had to think about what we had to do to finish the convention centre. So that we eased it back a little bit, and I think that's a good discipline. I think raising debt to pay dividends,
it's not really the point.
It's not, and we're anyway. But then in terms of going forward, we plan to stay. We'll continue to pay dividends. We'll continue to do it within the range, and really what flexes in the range is just what we see going on in the business, how the business is performing, where we think the market looks like, and if you're a bit more cautious, you get a bit more conservative. And if it looks really bullish out there and you see this, you might get a bit more towards and the board makes that decision as it looks at the business in the round each.
And in terms of expectations of going back to pay enough tax to imputation credit,
obviously. Yeah,
next couple of years.
Yeah. Look, so I think we've sort of said it's about 2 years away. And what happens simply is with the losses on the convention centre, they're painful in the context of having to pay them out, but they actually mean you have losses and you don't pay as much tax. So in a funny way, it protects you on what I call cash tax.
Yeah,
and until we start paying cash tax again, you don't get the imputation credit. So we're about a couple of years away from that. Yeah,
sure. What keeps you up awake at night? What do you worry about?
Pretty good sleeper, but no. The thing that it's safety. We're a big business and we're in a lot of industries where there are risks, and we've put a lot of time and effort into getting everyone home safely each and every day. But but it's so many moving bits, and that's I hate phone calls on a Friday evening or a weekend from a chief executive, because there's an escalation protocol in the business. And when I get those, usually what they say to me, it's not a safety issue or it's no one's been hurt and I'm not, they're being negative. Our safety performance has improved night and day from where it was 5 years ago. But that to me is probably the one that bothers me the most. And I think it's really important to be perpetually restless and concerned about it, because you let your guard down and someone can get hurt.
Yeah. When you came in to Fletcher, really in the first instance, I think do a cleanup.
Yep.
Where are you in that journey now? And what would you regard as being the job done?
Firstly, I was a cleanup to do in Fletcher's. What attracted me was just the business. It was a bit broken at the time, but gee, it was a good business. And the more I looked at it, I just thought, I'd love to get my hands on this. And I really went after the job hard because, hassled was Ralph Norris at the time, I wanted it because I could just see the opportunity in the business. And it doesn't mean the journey's been particularly easy. It's had its moments.
A few rocks on the road.
But as I look at it now and I go back to just the profits we're making underlying, the margins, and just where the businesses are operating, they're really in a much sounder, sustainable place. And sure, we're still getting the last clips of clearing that legacy construction book, and it's been a longer journey than anyone thought, including myself, but we're almost there. So, and once we're free of that, the business is in a really nice place. And I look at the team, how they're performing, and I'm more the clearinghouse of what we invest in now than the instigator of ideas. The culture's moved, the can-do nature's moved in the business. So I really love where we've got to. In terms of when's it done, it's never done. I mean, and that's there's always another opportunity. And what I love about our footprint is that, we've got an opportunity to grow the returns and the performance for shareholders, but we're having a big impact on the industry and bringing that innovation in. And as we sit here and look around the world and what we can bring back to help our customers and the markets and help the environment, it's a pretty exciting cocktail, actually, where a lot of stuff's aligning that's really quite fulfilling. So.
Well, thank you very much, Ross, for joining us today. It's been very interesting.
Pleasure.
Best of luck for the next couple of years. Let's hope nothing else breaks.
You didn't have to finish that way.
Well, thanks for tuning in, everybody. You can watch Shared Lunch on YouTube or follow the podcast on Apple, Spotify, or wherever you get your podcasts. Leave us a 5-star rating and a comment with who and what you'd like to hear about. We also have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch2023, you'll get $100 off the annual subscription to BusinessDesk, usually $349 including GST, and now you'll get the Wall Street Journal free of charge with it. The offer only applies to new BusinessDesk subscribers, can only be used once per subscriber, and can't be used with any other discounts. Enjoy the rest of your week.